because my tax professional is in the office and I wanted to think I'm actually working on it. But it's really important that all of you and all of your professional advisors know about what the tax implications are for early stage investing, because they're quite helpful and positive. So this is the first event about the tax impact that we're going to host. Depending on your feedback, we'll either stop it here or hold more sessions about this. I run into frequently early stage investors whose tax professionals actually aren't aware of this. And so one of our objectives this year is to address that situation. So without further ado, Peter.
Okay, all right. Speaking of tax professionals, I am not one. So talk to your tax professional. I know some things though, and I'd be delighted to share those with you, but this is not to be taken as legal or accounting advice. All right, so just a couple things quickly about Rockies Venture Club. Most of you I recognize, but those of you who are, maybe this is your first event, I'll just remind you, RVC is the oldest angel investing group in the country, and we're a nonprofit. And we have a deal funnel of about 1,000 deals per year that are coming in. We're pitching about 80, doing diligence on 24, and investing in 15 to 20. So that's a really healthy deal flow. It allows us to look at lots and lots of good companies. People might ask, why are we pitching 80 companies when the average angel group pitches about 24 per year? The reason is for you. So you can see lots of deals and you don't feel like you have to invest in pretty good deals because it's all we've got. You can look at a lot of them, see where the bar is set, and invest only in the very best. And so we have a wisdom of crowds concept going on, allows us to make better decisions. We also have syndication partners across the US. We're bringing out-of-state dollars into Colorado, but also seeing great deals from out the Western US, so it's not just limited to what we see here. We do about 140 events every year at Rockies Venture Club. Events like this, events like angel meetings, the upcoming Angel Capital Summit in March, the Hyper Accelerator next week, the Life Science Investing Night, February 13th, lots and lots of stuff. If it's an even or odd number day, we probably have an event coming up. 220 accredited angel investor members in Rockies Venture Club also makes us one of the largest and most active angel groups in the country. So, and me, most of you know me, I've been executive director of RVC since 2011 and managing director with Dave Harris and the Rockies Venture Fund. Founded Biz Girls, Rockies Venture Institute, board member of the Angel Capital Association, and wrote the Venture Capital for Dummies book. So here's our topic. Last month, Congress brought us a tax bill for better or for worse. There's some interesting things. The better part is we were really worried that these things we've had now for 6 years might go away. They were endangered as we went through this tax bill, and we have lobbyists who've been working with us in Washington to make sure that they survived the bill, and they did. So that's the really good news, because these are some of the most powerful incentives for angel investors out there. And I'll of course talk about these because these are just a bunch of numbers. But there's really a couple of new things in the tax bill as well that affect angel investors. And the main one is the Investing in Opportunity Act, that's 293. And basically what this is it's rewarding investors who invest in economically depressed areas. So this is new. John Hickenlooper and his team have 90 days to identify what the distressed areas are within Colorado. And it can be about 20% of the state. And then it's got to be in low income census tracts. And what's interesting about this is compared to Section 1202, which I'll tell you about in a second, it's not that great. It's either a 10% break on your capital gains if you hold for 5 to 7 years, or 15 for 7 to 10, which is, it's nice, but it doesn't quite match up to 100% capital gains tax. But there are a lot of investment opportunities that the 100% capital gains tax exemption don't apply to. So if you are looking at real estate opportunities or companies that are older than 5 years or have more than $5 million of revenues or things like that that are in these opportunity zones, then there are opportunities to save up to 15% in your long-term investments in this bill. So let's just talk about angel investing for a second. Oh, by the way, I didn't talk about ground rules. Interrupt. Otherwise, I'll just talk and talk and talk, and then, we'll all be done, and, we'll go home, and it'll be great. But nobody likes that. So, all right, so that's the new thing. So I just want to sort of give context about this and about how taxes and tax advantages that are available to accredited investors only make angel investing a lot less risky than most people believe it is. And there's a bunch of reasons why that's the case. And one is, everybody sees all these horrible business loss statistics, 9 out of 10 are going to go belly up. And nationwide, SBA or sort of some of the data you see, that's true. But a lot of those businesses are, seasonal lawn mowing businesses or hair salons or people who start something they never actually do anything with. The companies that we're looking at that have received investment have actually, first of all, they had to go over a huge hurdle to receive investment in the first place. And then second, they received investment. And the main reason companies go out of business is they don't, and so they don't have money and they can't go on. So the statistics for companies that have received at least an angel round of investment are much, much better than some of those statistics you read about business failures that come out of, the Secretary of State filings and so on. So there's, I've got a chart here just sort of showing this is what a typical portfolio looks like. With 10 companies invested, you're going to see something like, 50% of them might return less than $1, 35% of them. So 1/3, that's how many you receive a goose egg for. 1/3, is going to be nothing. And then 33% are going to be pretty good. 1 to 5x, not bad. And then 8%, 5 to 10, 5%, be 10 to 30, and then another 5 or 6 does 30 or more. So over a portfolio, the average angels are seeing something like 27% IRR. So it's a much less risky thing than people think when you invest with groups, do actual due diligence, and create a diversified portfolio. 3 main rules of angel investing. The fourth is keeping the money that you earn after you have these exits. Because somebody who doesn't pay attention to these tax rules, they may see 27%, but now they're going to have to pay 5.2% or whatever in long-term capital gains tax on that. So how do we save, 1/5 of all of our money, not sending it to Uncle Sam? That's what we're going to talk about. So stocks today, I hate using this slide, but gosh, we briefly hit 28,000 in the Dow Jones the other day. It's really, it feels like a bubble about to burst. So angel investing has a lot of great, opportunities, especially when you consider the taxes. So let's go into these 4 things that I want you to walk away having a really great understanding about. And by the way, I'm going to talk about a few things that you can share with your portfolio companies, like the R&D tax credit and so on. But these ones are mostly for you.
Is this somewhere in writing on the website also?
Yes, if you look on the RBC blog, you will see. You'll see angel investing is not as risky as you think. You'll see a lot of this, and you'll see some things about tax breaks that every angel should know, written by me.
What about this section numbers you're going to talk about? Is that also on the website, or are you going to share these slides?
I would be delighted to share the slides with everybody who has signed up, and we have your email list. Yeah. Ebo can take care of that. It's rolling up sleeves to get it done right now. All right. This one is the big one. This is the one everybody should know. And what's interesting is when I talk to CPAs and attorneys, most of them don't know about this. They're doing a lot of things, but they're not used to seeing the 1202, and this is the most important thing. And as you can see, 100% capital gains tax exemption. So you pay 0 tax. And I'm going to show you some examples of how this works. But there's some rules. And the first is it has to be a C Corp. No LLCs, no S Corps. So if we're investing in an LLC, all rules are off. We're going to have to pay full tax. So that's one reason we have pushed some of the companies we've invested in. We write a term sheet and we say conditions precedent to financing that they have to change from LLC to C Corp.
So what if you invest in LLC and then it becomes a C Corp?
So you can, with all of these, You can start the clock when it happens.
Okay.
So, and I'm going to talk about convertible debt versus equity as well, but it has to be under 5 years old. So this is for startups. I mean, this is so awesome because this is everything we look at RBC, right? So under 5 years old, under 5 million in revenues, and we have to hold the investment for 5 years. So those are sort of the big rules. This is also called the QSBS, the Qualified Small Business Exemption. You've heard this in other language. So you meet all these rules, and then you file with the QSBS. There's a place for it on the 1040, and you get 100% capital gains tax exemption. So it's great. Now there's some qualifications here. C corp, gross assets less than 50 million before and after purchase. That's when we purchase. If it's 100 million when we sell, that's cool. Right? We like that. Issued after 93. What happened was Congress phased this in. They first did it at 50%, and people were like, ooh, that's really good. Then they made it 75%, and they go, wow, that's even better. Then they made it 100, and since 2011, it's been continuously in place. And once again, did not go away in the tax bill last month.
What was the active business?
It's not it's actually a business like those we invest in. It's not like a shell type thing.
So what happens if you say you go for 1.5 years, you sell the business, you do it as an asset deal, keep the cash and the C corp, and then as 5 years expire, you distribute? Would that be?
That was way too complicated for me to understand right there.
Or you sell after 4.5 years holding, you have
Okay.
a half-year waiting, you keep the cash on the C corp, and then you do a distribution on the 5th anniversary. Does that meet the active business requirement?
Perhaps.
I don't know. Did you see my first slide? But seriously, I don't know. I mean, it sounds like it's not an active business, and that's weird. Angels want their money back right away.
Sure.
And wait till you see the next section that I have to show you, which might be a more legal and productive way of dealing with that situation.
Here's an easier question.
Yeah.
Is there a way, or do you already do this to document this at the time of purchase? Just because I'm sure 10 years later it's going to be hard. If someone challenges that the investment was truly a qualified small business, that we could go back in your records.
It's a good question. As far as I have seen, so I've seen like my tax advisor, there's a little thing where they ask about QSBS, and I've seen it on the tax forms, but they don't actually anywhere, including in the IRS code, talk about what documentation you need to prove that it was under five,
I might
and held
ask
for
for
five.
a rep from the company.
Yeah. I mean, if you look at our due diligence stuff, we have financials that say they're making nothing, or whatever it is.
Some funds and some companies will issue a statement looking back and certified.
Yeah. Yeah. I mean, we could ask for that certainly
Use it more complicated.
at the time of investment or even at the time of exit, and they could do that as well. Okay. All right. Held for 5 years. It has to be an original issue. So if I invest in a bunch of shares and then you buy it from me, I transfer it in a secondary transaction, that doesn't work. Right? So you have to buy it from the company
But it works for you if you're selling it.
after 5 years.
5 years. But if the company raises or does something happens and 5 years hasn't been met, if they do a turnaround and are acquired, there's another slide.
There's another slide coming up for that.
Oh, that's slide. Thank you. Sorry.
That is a great question. Yeah. All right. So here's some other things. These are things that don't work as a QSBS. So, sort of service, architecture, lawyer, performing arts, consulting, athletics, sort of businesses that we don't ever invest in at RBC, those don't qualify. Banking, insurance, financing, leasing, those don't work. Farming, any of these things, motels, restaurant, none of these are anything RBC has ever even looked at, much less invested in. But if you're thinking about this for other investments that you might be involved in.
So what about P2BI? Is that qualified?
Yeah. Definitely qualifies.
It's not-
I know it's lending, but it's also a tech platform, so you're good. All right, so here's some examples, and I want to show you sort of what it looks like in terms of returns, because there's a couple different ways to look at it. So invest $3 million We wait 5 years and we sell it for $30 million. So the gain is $27 million. So we have a choice of either 10 times the basis or 30, which is $30 million, or 10 million. So $30 million is greater than the 27, so the entire gain is excluded. So $27 million tax-free. Right? So just sort of thinking, it's, you know, this could be really a big difference. So here's a second one where we sell 5 or more years later for $40 million. We gain 37. So the greater of 10x our basis, we, wait, does it say how much the investment was in this one?
3 million.
Oh, 3 million again. Okay, yeah. So, so now 7 million of it is going to be over the $30 million limit, 10 times our original basis. So we'll have to pay tax on the 7 million, but the 30 is still good. Okay, so that's saving us $6 million. And you could donate that to Rockies Venture Club. Did I mention it was a nonprofit? If you do get that kind of savings. Yes.
Peter, my question is, I guess, Rockies Venture does an investment to an LLC as part of a tranche. The members would be K1s, but does this pass through?
It does. Yeah, so it totally passes through both this and the Rockies Venture Fund, which is a limited partnership. So LLC and LP both would have pass-throughs. So we would, within a fund where we have 25 investments, any one of those would be subject to this, this rule. Okay. All right, so here's one more. Investing a smaller amount, $500,000. We sell for 11 million, gain of 10.5. So 10x basis gives us $5 million, or 10 million. In this case, the 10 million is well, it doesn't even matter. Let's see, 500 of the gain is taxable because it's a little bit over, but the 10 million is not. So you save $2.3 million in taxes. So there's just, it's just, you know, looking at it, if it's bigger or less, you pay whatever beyond the minimums.
So does the 10 million limit apply to us as individuals or to the LLC?
To you as individuals. Yeah, so everybody takes advantage of that. All right. So now let's talk about the thing that you all are talking about, Christian, John. What happens if you have an exit prior to 5 years? You've got 1045, the investment rollover rule. So this allows you to extend the clock. Now, it's just like many of you have done a 1031 exchange in real estate. You're moving from one thing to a like investment. So here, it's the exact same principle. You have 60 days to reinvest, and you can reinvest in, you know, if you want to do, you know, if you've got a good return, you might want to follow your diversification principles, and you don't have to put it all into one more investment. You can now put it into 5, 10, 2, 3, you know, whatever number you like. You may also invest it into a fund, you know, that's investing in like deals. So 60 days though is the limit, and you want to designate, you know, that you make that investment so you can roll it over.
Just curious, what's the limit on 1031 rollover? Is it the same? I was wondering what the time frame is, just curious.
Oh,
It's
it's
like a
probably
year.
similar, I think.
It's like a year.
It's not 60 days,
There's so much time to
You
identify the
have to
property.
identify property, then you have so long to close.
because it takes so long.
60 days to identify property.
60 to identify and then longer to close. Okay, all right. Good. Yeah, got you in the audience. Thank you.
So Pete, does the time clock reset to 0 when you do the rollover?
My belief is that if you go 3 years in the first one and you roll over, then you need only go for 2 years to get the most you want. So I think it builds its sequential.
So if I understand correctly, I get money from one investment, let's say Team Snap.
Yep.
And I want to, it's less than 5 years, then I want to put in P2PI. If I invest in less than 60 days in P2PI, I don't pay no tax. Is that right? On the
Right.
gains?
Mhm.
So it has to be another small business.
Right.
type.
Another QSBS.
Okay.
Exactly. So this is pretty cool, right? I mean, we all like early exits. And so when we get them, this is a way to sort of keep the tax clock going. All right. Next one, let's say things don't go so well. We saw the 35% will come up as zeros, right? So most of the time, you all know what happens with long-term capital losses. You can only write $3,000 off against ordinary income. But Section 1244, if you have a write-off from an angel investment, you can take up that entire write-off in the year in which it occurred. So you put $10,000 into a deal, 3 years later, they go belly up. You can take that write-off right then. And now if you think about it, you've just gotten, if you're in a 33% tax bracket, you just got $3,300 back from the IRS. So your actual loss in that investment was only $6,700 instead of $10,000.
Does it have to be a C corp or is this for any company?
I believe this one all wants to be a C corp also. So it's kind of, and when I'll just go back to one of the premises of an example I gave in the angel investing is not as risky as you think article. So we also have the, my next slide will be on this, but we also have the Colorado Advanced Industries Tax Credit. Oh, I got something else on that. And if you think about the tax credit, so that same $10,000 you invested, you get 25% back if you invest in the first few months of the year. So now your money at risk is $7,500. Now you have 3 years later, you have a complete loss, so you get $3,300 back additional. So now instead of losing $10,000, you actually lost I can't do that math that fast, but $4,700 is your maximum loss in that circumstance. So suddenly, instead of worrying about angel investing and thinking about 100% losses, your maximum is actually less than half of what you've invested.
Peter, what's the versus 3,000 per year? Is that a standard deduction?
So let's say you invest in a non-QSBS, invest in some, just in a stock, Enron, and it goes to zero. So $10,000 in Enron, it takes you 3 1/3 years to write that off against ordinary income. And you can, IRS allows you to do the loss carry forward, so you can do 3,000, 3,000, 3,000, 1,000 in that case. But for something like that, where you get a goose egg on a non-QSBS, you can only do 3,000 a year. It can take a lifetime to sometimes catch up at $3,000 a year if you invest well.
You don't know. That's a lot of losses.
Yes. Let's see. Some other things about the 1244 must be part of the first $1 million raised by the company, which is once again usually where RBC is, and we have a limit of $50,000 per year. It must be a C corp. Okay.
Single filers and joint filers, you're talking about individuals?
Yeah.
So what if you have your own company, a pass-through LLC that does this investment through RBC, does that create any kind of issue with it?
Pass-through should be just fine.
Pass-through's okay.
Yeah, pass-through, everything is all passes through pass-throughs. Yes, so it's good.
That first million, is that defined as equity or also capital, debt? So the company has a lot of loan notes and so on and so forth. Would that only apply to the equity portion?
So for like convertible debt, for example, I'm sure that would count as capital raised, not just equity. Okay, so fourth one is Colorado Advanced Industries Tax Credit. This one is also works in a pass-through basis through the LLCs. So the way it works is we invest, let's say we get 10 of us together, we invest $150,000 in something, 15,000 each. The LLC files with the state, the company files with the state now more quickly. It used to take them like 6 months to do the damn work, but now they will get back within a couple of weeks, say you're in, and then you file for this tax credit. So if you did, $10,000, you get $2,500 back. We divide that up pro rata among the people within the LLC. So that's how that works. Now, some things you need to know about this is there's a pool of $750,000. And when it's gone, it's gone. So this is a use it or lose it, file early. Dave is running down to the bank today to make sure we got in our things for one of our first investments of the year. So it runs out around March, depending on how activity works. There are other limitations. It's up to, is it a maximum of $50,000 on any one deal? So if one person wrote a check for $200,000, they could get the full 25%, but if they wrote a check for $500,000, it would still be that $50,000 maximum per investment. Okay. Questions about AI tax credit? It's totally awesome. It's like free money. All right. So here's another one, and it's just important for people in the startup world to know, because there has been a change in the tax code on this that makes it now applicable in ways to startups that it was not in the past. So as we are advising our portfolio companies, they may not realize two things. One, R&D is defined quite broadly. So a lot, if you have people coding or if you have consultants working with you, there's all sorts of things that count as R&D that most people might not be thinking. They might think you need a wet lab and scientific stuff, but no, actually a lot of what our companies are doing and a lot of what they're spending our money on is in fact considered R&D. So the way this one works is it's up to $250,000 a year, and the big change is it used to be only against income tax for the corporation, which sucks because most of our companies don't actually pay income tax for the first 5 years practically. They're losing money and having lost carry forwards, so they don't really have anything they can apply this to. But now, with this change in the tax code, they can apply it to payroll taxes. So most of our companies we do invest in pay payroll taxes, and they can write off against those. So it becomes
We did that last year, we got $8,000 back. This year we're getting much more.
Yeah.
It's great.
It's cool. So let's see, under 5 million in revenue, file 67, 65, and I have 3 more slides on this, just sort of things you need to know. Up to 6.2% of payroll, it's not 100%. Up to 250K, and limit be utilized against future federal and so on. Carried forward for up to 20 years. So here's an example. Startup raises $4 million doing smart dental stuff. They paid $1.1 million in wages. Third-party expenses $63,000. So they spent a total of $1.89 million. And I'll just go back here. The third-party contractor is 65%. So the $63,300 that they're spending there, they get $41,145 is countable as expense. So that adjusts to 1.1, and they can look at how much they got, and they can write off $116,000 in this case. So only for the first 5 years on qualified startups, but this is great. It's non-dilutive. I mean, $116,000. I mean, that's pretty good for Colorado companies. So just something about slow money and philanthropy, and thinking about how you manage your giving and how you keep. A lot of people have 2-pocket philosophies. They've got their one pocket for philanthropy and one pocket for investments. You can actually do some interesting things using these tax codes. And here's an example. You could give $1,000 today to charity of your choice. It's great. They use it. You get a write-off sort of for that now. Or you could invest $10,000 into QSBS and get up to 55% financial return while also giving up to $100,000. So that sounds like Ponzi shell game, right? So here's how it works. Let's say, boy, I hope I can, see how I came up with these numbers. But I made this slide a little while ago, so here, I'll make it up. All right, so here's probably what I was thinking at the time. So put in $10,000, get 10x. So you get $100,000 back, tax-free. And you could, now you've got $100,000, and you give that to the charity of your choice. You get a 33% tax write-off, so you get $33,000. How the hell is that 55% financial return?
I think that's the plan. 55% IRR for tax. Depends on how many years.
Listen to Doug, he's got it.
Yeah, 5 years.
Yeah, right.
And you just,
Yeah, it's not 55% of the $100,000, right? Because it's only on
but
the
assuming
10,000.
you don't,
Yeah.
capital gains tax,
Exactly.
you just,
I did, by the way, put this into Excel and run the IRR command to come up with this number, just so you know. But yeah, but the idea here is you can get your $10,000 back. So if, and it, if it was 100,000 or 1,000,000 or whatever it is, you can, if you have an endowment, family, whatever, you can put that money back in there for your heirs. You can give this money and you can take advantage of these write-offs. If you're in the 33% tax bracket, you get $33,000 worth of tax benefit from giving that $100,000. So just kind of an interesting way of thinking about leveraging giving while still maintaining the value of your family estate. All right, so I'm going to end with 2 examples of angel investing using all of these things versus a fairly typical conservative approach. So we've got Freddie Frugal here, who's going to invest $100,000 at 8% compound. So that's pretty good, right? That's sort of standard S&P over the last 30 years. That's good. So let's just walk through year by year how Freddie does. So first year he puts in his $100,000, it's worth $100,000. So he gains $8,000 in interest. That's good. Of course, it's taxable. So he pays $2,640, ends up with a profit of $53.60 in that first year. So now his investment is worth $105,360. Are you still with me on that? Okay. Next year, he's got a little more. So he gets $84.29, pays $27.82 in taxes, profit of $56, and we put 11. So you see how that goes. Come down to the bottom. He ends up with $129,000 after tax after 5 years. And I know it's in his 401k, whatever, blah blah blah. But this is we're doing light investments here. So pretty good, right? That's not bad. So his net IRR after tax 5.93%. So that's sort of the standard. What we all when we're doing planning and all that kind of stuff. That's what we kind of look at as pretty acceptable numbers. Now let's look at his friend, Andy Angel. So Andy takes that same $100,000 and he's going to invest in a diversified portfolio of 10 angel investments at $10,000 each. So he invests $100,000. He immediately gets $25,000 return. How do you do that?
A tax.
AI tax credit, right? So now he has, what's the value of his investment? $125,000. Because he still has $100,000 worth of stock that he bought. Plus he got this gift from the state of another $25,000. So we count that. Next year, 0. Doesn't make any money, okay? This is slow stuff, right? Next year, so here's what I've modeled is he's got, he's starting to get failures. So it takes, not surprisingly, sometimes at the end of the second year is about when companies will start to fail, if they're going to fail, because think about it, our typical investment is a 12 to 24 month runway. They don't prove what they're going to do. 24 months comes along, they need more money. They didn't hit the milestones, no, they're gone. So we start to see 1.5 of these companies gone. So they've lost how much? That's $15,000 of loss, right? Because they were $10,000 each. So, but the taxes here are minus $4,500. Gets $4,500 in reduction in these taxes. That's like cash back from the IRS. So we add that to the value of his. So we reduced his investment. It was 125, so now it's down to 110. But he got this 4,500 back from the IRS because he used the 1244 accelerated loss on his taxes. So he's got 114,000 left. So still ahead. Next year, another 1.5. Go belly up. Loses 4,500, but gets that as a tax write-off. So now we went down, added the 4,500 back in. Same thing again the next year. Now we're down. We've lost. We're below the original by $6,500. Still not too bad. But now we're in year 5, and now we start to see, the typical 5-year exits of the remaining companies who did not go belly up. So I've modeled this using the traditional 3X for a portfolio. So I'm not doing the 10X. We all shoot for 10X, but end of the portfolio, we end up usually at about a 3X, and that's it's a real life type thing. So we're showing this year returns of 295. I'll give you a little bit under that. So we had that, and now we've got $333,000 is the 295 added to the 93. And so that gives us a 31.5% pre-tax. And of course, this is all non-tax because of 1202. It took 5 years. So now we get the full 333 that we put in our pocket. So compared, to 5.9 or whatever, it's 5 times bigger, and so what is that? 3 times the return on investment. So that's sort of using every single tool at your availability: the 1244, the 1202, the tax credit, and all those things. So that, my friends, is how to save money in taxes. Now you see I have no more slides. Are there any more questions?
Did you go back to the last slide? I was trying to see what the taxes and 13,500. How did we get that back? Maybe I missed it.
How did I get these back?
No, the bottom, the 13,500. Because if you made.
Oh, it's the total. It's
the total of that. Okay, I'm sorry.
Yeah. 4,500 times 3.
The Colorado tax incentive, is that only valid for Colorado-based investors?
Yes. Investors and investments. And it needs to be in one of the 7 advanced industries,
So
which
here's,
most of our investments are.
you're assuming you have 10 startups, you've invested 10,000 each. And is this, I'm seeing it as you're saying that every one of these companies had this Colorado tax option.
I took it. Yep.
You might be good to have 1 out of 10
We're,
because of that short
we
span.
invested fast,
I see.
all in the first 3
Okay.
months.
We formed one new company every single day in Colorado.
Yeah.
One new company is formed every single day, so.
As
Yeah,
long as
it's
they're
not
worth
too bad.
investing.
You're right. I mean, if I invested it evenly over the first year, well, first of all, then I'd have to go into year 6, all that.
Sure.
So it's complicated enough as it is. But I'll be glad to give you the spreadsheet. You can go play with it all you want.
Easy question, I think. So does Colorado state taxes, do they follow federal treatment? Is there anything special?
There's some a few special little things, but for the most part, it's.
Same.
Oh,
Like
but the 1202, no,
You don't?
you don't. You still have to pay the
So you get that back.
4.75% or whatever the Colorado tax.
Oh,
Yeah, so that's. So actually, but I didn't take it out of the other guys either. So.
Both these guys are going to jail.
Yeah.
Is there any alternative minimum tax consequences?
So there are, and this, don't quote me on this because I've read
Writing
through
down.
all of the 500 pages of the current tax bill, and I've read a whole bunch of stuff, but I believe that what it said is the 1202 also allowed you to avoid some of the A&T.
Oh, so it's beneficial?
Yeah.
Okay.
Yeah, because you think about the 30 million on that one example, would clearly, start kicking in some A&T. This is, once again, remember that second slide.
No,
But
just
my
part of the
belief is I
conversation.
read that it is exempt from A&T.
I think for investments that you invested in before '09, so if you're before the 2010 group, there is some AMT. So just be careful if you're looking at older investments.
And of course, with those, you don't get the 100% either. So.
Peter, when a company is obviously gonna fail, like what do they have to do to officially be done? Because it seems like they're gonna limp along, and you still can't take your tax deduction.
Well, interestingly enough, this is a discussion that Dave and I have been having recently. So we're coming upon, out of our 35 investments over the last 4 years, since we started the new model, we've had 0 failures. Up to today even, technically. Even though Dave and I are like, we know Content Boulevard is dead. So we've been saying, well, how, And we basically have said, look, you guys just give us a letter saying, closed up shop as of this date. And we actually have been having this conversation for about 8 months. And we said 8 months ago, hey, I think our investors by 12/31 would like to get this letter so that they can write off this year rather than next. We haven't really gotten that letter, but the deal was in default as of last September, August.
Last year.
Yeah, of last year. So we could just, given the non-responsiveness of the CEO, and he's always doing something for 2 weeks before he can get back to us. So we could take that note being default and probably use that as a.
Or you could wait until this year when you think it's more beneficial against income tax. So you can kind of play around with it. You know,
That's a big thing is this documentation. I think, we're talking about documentation at a closing down of a business, but documentation on the initial investment. So if I want to talk to some tax advisors, this is what I've done, I've invested in these, my portfolio companies, obviously. What documents do I need to keep and maintain and show to these professionals that we're doing the right thing?
I will tell you that the actual code has almost no guidance on that.
Oh, gosh, okay.
You
can make it up.
So, well, you want to document, what the revenue of these companies were, and all that kind of stuff. But, we have all that stuff.
Yeah, wouldn't you find anyway, because in Tony Rockies, so as well, prove the company's still around, so they can't reach the guy, and therefore, there's no way of proving that this company still exists.
Yeah, and in fact, didn't the LLC actually fail to renew for the company we invested in quite some time ago? So that's another.
even an email, I use just email. Guy didn't bother, he says that things aren't going well, that's good enough for me.
Yeah.
Like Kristen said, by the time IRS comes around and checking out, the company's definitely gone.
They want to find you,
Yeah.
they want to find you.
How do you sell out of the investment? At the end of the 5 years, is it just an individual that makes the decision, or who are they selling?
So typically, and this is a lot of what RBC does, is we're helping people to, find merger and acquisition partners, to buy out the whole company, or, IPO someday would be nice. But it's usually everybody does it all at once. There are some secondary market things, but it's very thin, we're doing a secondary market purchase of some shares from PTB investor, from an RBC investor who needs liquidity, so we're buying from him. But otherwise, usually the company is being sold altogether in the good exits.
In one case last year for me was, the funding was oversubscribed and I wanted to sell some of my shares. So I was able to sell to people who were going to get in the company. So you could do that.
Yeah, it's usually pretty hard to sell. And this is why angel investing, we're shooting for a 60% IRR and ending up with, 27-ish, is we have a long lack of liquidity, in addition to risk. So we had Dwayne Peterson, one of our investors up in Fort Collins, he just had an exit recently that went for 16 years. He's like, yeah, I got 20X, and then 16 years. Think about the IRR over 16 years, 20X is suddenly not as good as 4X in 3 years. But he was not complaining. It was fine. Okay.
Hardest question for last. Does it make sense to route your investments through an LLC, given the 2018 tax law changes with there's a pass-through deduction of 20% of revenue for the company for an LLC?
So we were just talking about that a little bit.
Or is there other advantages?
That we're gonna have to look at that one. I don't think it really applies to angel investing going through LLCs. I think that's a wash one way. You're already getting 100% off.
Well,
Anyway.
for deals that don't fall into the other categories.
Yeah. I'm not sure about that as an investor. I know that if you're painting houses, it's probably a good thing to do.
They're just going to do it anyway.
Yeah.
We still have the flexibility.
Fair amount of people do at RBC. Meaning you set up Doug's Investment Corp LLC.
Yeah, and that's the legal name on the forms I give you guys.
So that's common. Probably, would you say, Dave, a third of people do that? Would set up an LLC or?
Yeah, probably like 4
So,
That's right, fourth,
Just another.
four people that set up an LLC invest. To invest.
Kind of create their own little fund to,
I think
they can write off your expenses and so on.
the answer to the new answer to the question about incorporating yourself, depending on ordinary versus capital gains. It helps if you're taking in ordinary income.
Right, because then you're at the 20% rate instead of 33 or whatever it happens to be. Yeah. And so this would, given that investment would be a zero ordinary income, that would be a wash.
So it sounds like we should only invest in a C corp right now.
Yep.
With the new-
So let's just talk about that for a second, because this is where Colorado attorneys are letting the startup community down, right? Because Colorado attorneys are telling people, no, absolutely, be an LLC.
Right,
And
exactly.
Vortic
Everybody
watches,
knows.
the guy said, no, they're telling you bad stuff. They're evil people. You should always be an LLC. And then he charged them $6,000 to update their LLC operating agreement. It's like, well, I know who's evil here.
Does it
But-
matter if you're a C corp in Delaware versus Nevada, or is it?
Nope, doesn't matter. Yeah. We're fine with Colorado, Delaware's a pain in the butt.
Well, I think there are some cases where if you're self-funding and you want to write off your expenses, you can start out as a S corp or an LLC, and then when you get the money from the investors, you can
Absolutely.
change it. I think that's not evil.
Point well taken, and I actually tell people to do that.
That's what I always advise.
Yeah,
I mean,
yeah.
I would never tell someone, don't be a corporation or in circumstances, particularly if you're looking for third-party investors. I mean, that's crazy.
Yeah.
I don't know who told you that, but that's terrible.
Yeah, some poor client's attorney.
And $6,000 operating agreement is also crazy.
Yeah, except for a struggling startup, it
That's
was not,
crazy.
it was not good.
Bad legal advice.
So, but to Praful's point, if we,
As an
they start,
investor for me.
they start as an LLC, that's cool, they can write off those things. And then, we always have conditions precedent to financing, just we'll convert to a C corp. And, then they can do that rollover, and people are always worried about, it's gonna cost me money. It's like, yeah, well, that'll be part of the money you get, from.
Also, it's inexpensive. If you
Yeah.
have good affordable counsel, it's conversion to
A few $1,000.
C
Does the
corp.
5-year rule start when you become a C corp, or does the LLC, is that part of the 5-year?
When you become a C corp.
So it's actually better to start as an LLC and become a C corp than when you get 5 years.
Oh, the 5 years of age? No, that's LLC, of founding. So if you just change, I'm an LLC, now I'm an S corp, now I'm a C corp, and you go 14.7 years. That's not gonna work. No. But the other thing I want to point out, and this is, I'll just get on my little, convertible notes soapbox for a second. This does not work for convertible notes. And, some of you might have seen some blogs I've written about this, but there's at least 20 reasons why companies should not use convertible notes. But from our point of view, this is one. Because if it's a convertible note, it doesn't work with the QSBS 1202 write-offs. So why not make it, an equity deal? Let's be grown up, we'll value it. And there's so many, every single, except for the one you got, every single objection has no basis in why we should do it. And yours is, once again, when you're starting, you have friends, family, and fools, they could do a convertible note, okay. But once you get to professional investors or, angels, then it's time to be.
So you come across a situation where there's convertible notes and they convert and you still meet all the the S.
Sure, yeah.
Yes, and then it's still fine.
Yeah. So that's why friends and families,
Right.
that's cool, they can't value it. We, just to clarify some of the things, people say, we'll do convertible notes because, it's so early we can't value it. No, every convertible note we do has a valuation in there, and it's called the valuation cap. Every note we do has a valuation cap. So you don't get out of doing valuation. All of the things that people think about are basically, they have no foundation. And by the way, it's not just better for investors to do equity, it's better for the entrepreneurs, right? They don't have to be paying interest and being continually diluted all the way through. Dave and I are seeing about every third month a company that's defaulting on their convertible debt. We have, a security agent, we take over the damn company. We don't want to, we roll over and, sign extensions or whatever, but if we were evil, we could take over these companies, and they're putting their companies at risk. And for angels, let's say we're getting 8% interest on $100,000, we got to pay $2,500 in tax every year. And a lot of people don't realize that. They think, oh, it's rolling over into future equity. Nah, you got to pay the interest as it accrues, even though you get zero cash. So you invest that $100,000, now you get $8,000 in accrued value that's going to go into equity. You have to pay tax on that every year. So you pay tax on money you never get, and the company may go belly up, you'll never see it. So why would you want to do something that's diluting the founders, causing investors to have to pay tax every year on money they didn't even get, and having to pay 20+% in long-term capital gains? There is no reason that any company should ever, ever, ever do that, except for the friends and family. Yeah, and here's the other thing. Sometimes people say, oh, it's just a bridge. Well, everything's a bridge, right? Series A is a bridge to Series B, right? C to bridge to Series A. They're all bridges. And the fact that it's a bridge actually means it's more risk rather than less risk. So why would we do a convertible note, which has a much higher risk both to the company and to the investor, to further magnify the risk? And we just had this one that just defaulted or was going to default at the end of this month. And what are they doing? They're trying to get us to cure the default so that they could go raise another damn convertible note. That's like, stubbing your toe and then kicking the other one. It's like, why do you hurt yourself in this way? But anyway, so that's my soapbox. But we can help both the attorneys and the CPAs and the companies in the startup community learn about how to do better for themselves by using equity investments. Oh, and don't even talk about safes or any of those things.
Yeah, tell us about safe.
No.
Safes are dangerous. Let's just say that. They're not
Also,
safe.
nobody in this market, nobody here anyway wants to use them. That's just reality. They're popular in Silicon Valley, they're not.
Yeah, that's because I got a safe deal, came across my desk this morning, and just delete.
They don't, local investors don't have anything to do with them. If you're courting SB money, then maybe, but not here.
For the newbie, can you tell me what it is in a sentence, or at least what it stands for?
So it's a simple agreement for future equity. So it's not convertible note, it's not equity,
There's no debt remedies, it's
no
not
debt
equity.
remedies.
It's kind of a handshake.
Yeah, it's just bad.
Bad idea.
It's
No.
don't do it.
Like Silicon Valley.
No, it is.
The funny thing is, it was invented by 500 startups? But
Y Combinator.
Y Combinator, yeah, Y Combinator. But when Y Combinator takes their chunk of equity after the program, do they take it as a safe?
No.
No, of course not.
They don't eat their own dog food. That is for the stupid angels. So. All right. Anything else?
One more.
Sure. No, dude.
Given everything you presented today, it seems straightforward just to use the funding mechanism through taxable accounts here, as opposed to self-directed IRAs, or am I missing something?
Yeah. Well, some people use self-directed IRA. I mean, I use my self-directed
That's where the
IRA.
money is. That's the reason I use it.
Yeah, you do miss some of those things, but it also allows you to tap in, like we talked about, tap into some funds that maybe are
sitting
liquid. Yeah. So the returns are better, even without the taxes. Andy Angel's doing pretty good.
That's true.
To start with.
On the 60 days rollover rule, you have to say, I got this money and 40 days later I invested in that company, or can you is there documentation needed?
Sure.
And do you need an intermediary like you do a 1031 exchange?
I don't believe so.
I hope not.
So just the contracts, the sales purchase of the investment contract.
Yeah. I mean,
Detailed form you fill out.
Okay.
But most of that, you just need that documentation when you get audited. So,
Good point. All right.
No pressure.
all right, well, feel free to hang out, network. I'll be here, ask any other questions. I don't know if there's any more beer left. But otherwise, thanks for your attendance, and it was a fun evening.